Stock market investors are nervous as interest rates explode higher. We'll explain the details, so stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. Mortgage interest rates have been skyrocketing in the early parts of 2022 here. And this is causing many investors to become concerned and in some cases even panic sell their stocks. So we're going to take a look at what's causing this. We're also going to look at the conditions of the market right now. Here's a recent headline: mortgage rates jump again, causing headaches for home buyers. The 30-year fixed mortgage rate is now at the highest level since April of 2020. Here's a chart of the 30-year fixed mortgage rate. You can see since the fall, the rates have been creeping up, but then we've got an acceleration of the rates higher here just in the last few weeks here. It's all the way up to 3.7%, and that's a percentage point higher than it was just a year ago. With mortgage rates increasing, it now makes it more difficult for people to buy a home, which could lead to a downturn in our stock markets and the overall housing market. Here's another headline: rising interest rates could keep a chokehold on tech and growth stocks. The Fed is talking about increasing short-term rates. They haven't done anything yet, but you can see here bond traders are causing interest rates to go higher. So what's causing these interest rates to explode higher? We're looking at the Cpi Index, Consumer Price Index. Right now we're at 7%. Each time the CPI has moved above the 6% level, it's been followed by a recession. You can see these bars here. These are periods of recession. It's very probable that some point here in the future, we're going to get into a recession again based on this chart and information. Now, we're not trying to scare everybody to sell all your stocks right now. The Fed hasn't started to raise rates yet, but we've looked on some of our past episodes. When the Fed funds rates start to increase and we reach a certain threshold, then the market can turn to the downside and a recession follow. We're looking at the Nasdaq 100 chart, QQQ. You can see the price of the Nasdaq 100 in 2022 has been moving lower. It's actually below the 50-day moving average, this red line here. Typically, when stocks are below the 50-day moving average, nothing good happens. We're looking at the number of stocks above the 50-day moving average in the Nasdaq 100. Right now, we're around the 26% level. There's approximately 100 stocks in the QQQ. 26% of them are left above the 50-day moving average. Now, you can see in the past, when it gets to be around 15%, we typically get some type of a bounce in the markets. So if we get down to those levels, it's very possible we get a bounce higher in the markets. We're not in a bear market yet, but we want to be watching the markets very closely. If you have additional comments on why the markets are starting to move down, leave your comments. It helps all of us to be better educated. With interest rates going higher, some of the housing related stocks are also moving down, with Zillow down 75%. Other stocks that are down: Beyond Meat down 67%, ARK Innovation ETF down 52%, Home Depot down 11% in 2022, Salesforce, Amazon, Alphabet, Adobe, Netflix, PayPal all down in 2022. Okay, what's going to happen to the stock market here in the future? We're looking at the Nasdaq 100 QQQ. This is a weekly chart going back a little bit over a year. You can see here, since the first of the year, we're coming down. We're down about 10% at the time of this video. With interest rates quickly moving higher, it's causing a shock in the markets. I think once the markets get over the fact that it's going to be moving up possibly higher than expected, then we'll start to level off. Even if we get a 20% drop here, that's not going to destroy the markets yet. The economy's still good. Interest rates rise for a reason, and that's usually because the economy's good. They've got to slow it down some. We've looked at some individual stocks, and we're seeing some selling in individual stocks, and we also looked at the number of stocks above the 50-day moving average, and we can see fewer and fewer stocks are above the Nasdaq 100 50-day moving average. But for the most part, the index funds like the S&P 500, the Dow Jones Industrials, the Nasdaq have been holding up. And why is that? The top 5 or 10 most heavily weighted stocks are still holding up, and those are holding up the index funds, even though quite a few of the other stocks are down. Take Apple, for example. That really hasn't move down much. But if Apple starts to sell off, things could get bad in the technology stocks and the markets in general. So I want to thank you for watching. If you have any comments, leave your comments. Stay tuned for our next update.